Hi, folks, and welcome to the Meaningful Money Podcast. This is Season 18, Episode 7, The Ultimate Guide to Risk. This is the podcast dedicated to helping you put your finances in order. My name is Pete Matthew, and I'm going to share with you everything you need to know and everything you need to do to secure your financial future. I'm here to help you make sense of money. Here we are once again. Great to have you with me. Thank you so much for joining me. Now, risk is a constant presence in our lives and in our wealth building efforts. But what is it really? What is risk? How can we be aware of it? Should we avoid risk or should we harness it? So, lots to talk about in today's ultimate guide to risk. As usual, after the main body of the show, I'll look at a review that's been left, announce what we're going to be talking about next week. But before any of that, this podcast continues to be brought to you with the help of my friends at 7 Investment Management. They've been helping me out here on Meaningful Money since the spring of 2011, approaching 10 years. Amazing. So thank you to them. Do check out what they're up to. They're at 7im.co.uk. That's the number 7im.co.uk. Do go check them out and say thank you from me. Okay, so risk is misunderstood and very often incorrectly feared, or at best, avoided. Today I want to focus on the risks that you really need to be aware of, and you might be surprised at some of the things that I say, or you might not. If you've been listening for a while, you probably won't. This is not quite such a long session as the last couple of weeks. There's no workbook really today because it's a little bit more theoretical, but hopefully it'll just continue to provide context for the stuff that we've talked about in previous weeks and in weeks to come, crucially, when there will be more workbooks to download. But remember, notes and links, including a full transcript, they are at the show notes, which is the only link you need to remember as you're going through this. meaningfulmoney.tv/UG7. That's for Ultimate Guide, Episode 7. Also, stay tuned for more details on a special offer on the Build Wealth phase of Meaningful Academy, which is very shortly to run out. You've only got about a couple of days left to sign up for that. But, the Build Wealth phase of Meaningful Academy takes all this stuff and takes it to the next level and lots more besides as well. If you're watching this on YouTube, you can use the chapter markers so you can skip to the relevant points. You can see where we're going as we go through this. And you can do that on the show notes page as well with the audio player. Lots to get in the first couple of minutes, and just under 3 minutes, which is where I like to keep it. So just under 3 minutes in, let's crack on with what you need to know first. Okay, first thing we need to know, we need to understand the basic sort of high-level risks for wealth builders. Obviously, this is a finance podcast, so we're not talking about the risk of being run over or, contracting something nasty. This is about primarily the risk as it relates to building wealth. And of course, risk is everywhere. Multifaceted. It comes in different forms, you could say. And I've mentioned a lot of them before. I'll link to a couple of previous sessions on risk as well, so you can explore it a bit further if you want to. Inertia risk is a key risk. It's the risk that you'll do nothing. And in so doing, you might miss out on opportunities. And often it comes from too much choice, or sometimes in my case, too much financial knowledge, right? But not actually then having the wherewithal to press the button and get your money invested, for example. I see that all the time. Actually, one of the key reasons I still have a job as a financial advisor is that I get extremely smart, extremely capable people who understand pretty much everything there is to understand. But you know what? When it comes to pressing the button with your own finances, that sometimes is quite a big step. And so that's very often where I come in. FOMO risk. I'm sure there's a more official word for that. But FOMO risk is, I define it as always wondering about the next big thing. All right, so people who sort of struggle with this are people continually asking about Bitcoin or other crypto or wine investments, or perhaps the finer points of what a SaaS might do for them, when instead they could actually just be getting going and investing in stuff that they know works. It's a little bit like when you want to make the perfect YouTube video and you spend ages planning it, and actually the way to make the perfect YouTube video is to make a whole load of crap ones and learn it. Just get going, really. FOMO risk, right? Many investors fear the risk of total loss of their money, when actually that's an infinitesimal risk if you set things up right to start with. We're going to talk a bit more about diversification later, but if you're investing in equities, shares for growth, right, and you spread your money over hundreds or thousands of companies through a collection of funds, then really to lose everything every company in the world pretty much would have to go bust. We're either talking about literal Armageddon, in which case we don't need money, or we're talking fraud on a monumental scale, right? But those few aside, really there are 4 big risks that you need to be very familiar with, because in so doing, you can put that familiarity to good use and give yourself an incredible advantage. So let's look at them one by one. So big risk number 1 is incorrect estimations, incorrect assumptions when planning. So any plan, financial or otherwise, is wrong the second it's written because it's based on assumptions and estimates. I tell my clients this all the time. Still has use, of course, because it helps to set a trajectory, and that in turn informs decisions that you might need to make immediately. But the assumptions that we use when planning are obviously hugely important, and particularly if you're planning over decades. Most of us are when it comes to finance. 0.5 percentage point difference in your assumption on inflation or on the growth rate you choose for your investments in your planning can mean the difference potentially between your latter years being spent either in plenty or in penury. And it's not just numerical assumptions that we're using when plotting spreadsheets or the kind of planning software that I use every day. Any assumptions can be very wrong sometimes, like the assumption that you'll always be able to work, right? It's a reasonable assumption, you think, but what if your role is replaced by machines? What if you get ill? What if all your planning is based on you staying married, but instead you get divorced? Some things you just can't take out insurance against. I had one gentleman email me out of the blue to say his life had completely changed because he'd married later in life and had twins when he was in his late 50s. That would change your plan, wouldn't it? So we can't assume that things will continue, right? And those incorrect assumptions and the potential implications of those assumptions being incorrect on our financial planning is a big risk. Second big risk for wealth builders is market risk. Now, covers a whole broad spectrum of perceived risks in the mind of investors. Market risk it can range from concerns about total loss, like we mentioned earlier, to volatility, the range of returns you might get, and the up and down journey along the way. My colleague and very well-respected financial planner, Eugene Ngo, up country. That's what we say in Cornwall. Anybody outside Cornwall is up country. I don't actually know where Eugene is based. But he defined market risk as the risk that the market will not deliver the return needed to achieve your objectives. The market will not deliver the return needed to achieve your objectives. I really like that way of looking at market risk, because it starts from the point of defined objectives. Potentially we're back to planning assumptions again, aren't we? But it wonders, well, what will happen if the market doesn't live up to its side of the bargain? This is a real risk, right? Because we can't control markets, but we can control, to a point at least, the way in which we position our portfolios to benefit from market movements. We can constrain the impact of market risk by following some fairly simple rules for portfolio construction and management. All right, so market risk, that's a big subject. But really, it's about the risk that the markets won't deliver the returns you need to achieve your objectives. I'm having difficulty saying that. Achieve your objectives. Achieve your objectives. Big risk number 3, living too long. Now, I phrased that as living too long because it's evocative and it's a bit more memorable than inflation risk, which you could argue is the real culprit, really. Inflation is a massive deal. It's like the silent killer, particularly in retirement, if you don't have an indexed pension. We tend not to think about inflation when we're working because generally earnings rise above the level of inflation. I'm very aware that I'm recording this just shortly after a public sector pay freeze was announced. So generally speaking, earnings rise ahead of inflation. So we're earning a little bit more in real terms every year. But once you're retired, and if you don't have an indexed pension, or if you just have state pension, which is indexed to a point, or if the indexation is actually not enough to keep pace with real inflation, then inflation is a killer. Really, all of your investing should be focused on beating inflation and minimizing its effects. Take a fairly typical 30 or 40-year retirement horizon. 40 years is perhaps pushing it, but if you retire at 50, that's quite likely, actually. So can you remember how much a pint of beer was 40 years ago in 1980? I looked it up. It was about 35 pence. What is it now? What, 4.50, right? More than 10 times. That's a little bit of an extreme example, but You could start your retirement spending 30 grand a year, but end it spending 100 grand a year. Will your portfolio cope with that? All right, important question. Will you live too long, actually, and outlive your wealth? That's essentially the same thing, just addressed a different way. Inflation risk is a key argument in favor of leverage, actually. So while inflation works against your wealth by eroding the buying power of your money going forward, it actually works with your debt to reduce its value in real terms over time. I've used the example before. My parents bought the house that I grew up in 1979 for about £4,500. The average wage in 1979 was about £6,000. So, £4,500 for a house, the mortgage on that at the time, that was a stretch. We were a single income family. £4,500 though. My next laptop will probably cost that much. So, how many of us would love to have a mortgage of less than 10,000 quid? Now it's sort of play money for many of us. So that's the power of inflation, all right? And there is real value then in using leverage, other people's money, to accelerate wealth building because the amount of debt is reduced by inflation over time. As long as you understand, of course, and protect against the downsides of leverage, really important. I've talked about leverage in previous episodes. By the way, I should just mention, if ever I say something on the off chance that it might pique your interest, there's always links in the show notes, but also there's a learning center on the meaningfulmoney.tv website. So just go to meaningfulmoney.tv, hit learning center, and you can search for a bunch of terms. So hopefully that'll be helpful. So leverage, there's an argument for leverage because inflation essentially works with you in that regard. But if you're not comfortable with that, then you're going to have to invest a lot of money and you're going to have to work it pretty hard as it grows in order to get to a point of having enough to retire. And you're going to have to manage the withdrawal from that money in retirement in order to keep inflation in its place. Inflation risk is a real biggie, right? But the big risk number 4 is behavior risk. And all the other risks, in my opinion, feed into this one. Our ability to behave well towards our money or not is the biggest risk of all. If you get your approach to market risk wrong, you might bail out at the wrong time or fail to invest in a timely manner. One risk kind of leads to another. Inertia and FOMO risk that I talked about earlier, they are behavioral risks. Managing our portfolios is easy compared with managing ourselves, right? If managing myself was easy, I'd be 3 stone lighter than I am and I'd have abs like Gorka Marquez. Yes, I follow him on Instagram. But for some people, self-discipline comes easy, right? But for most, it doesn't. My father is an absolute machine when it comes to self-discipline. I honestly don't think the man has wasted a single second of his life. Now, I take after him to some degree, but his level of self-discipline is staggering. I bet you know somebody like that too. Maybe actually it's you. But behavioral risk, the way we behave around our money is crucial. Those are your big 4 risks then, as wealth builders. The risk that your planning assumptions will be completely wrong. The risk that the market won't deliver the returns you need to meet your objectives. The risk that you'll live too long and your money will run out and that inflation will damage that. And the risk that you'll do something stupid and derail your financial future. Okay, 4 big risks to keep in mind. Well, with that in mind then, let's see about what we can actually do to minimize the effects of those 4 risks. Okay, number 1, guard your assumptions. Okay, so if we are deliberate and intentional about our finances, then we are likely planning for the future to some degree. That might be fairly high level, some vague outline hopes and aspirations, and a general sense of saving and moving towards them. Or it might be much more granular with target dates, assumed growth rates, tactical asset allocations for our investments. I did a whole season on planning, so I'll make sure there's a link to that in the show notes. But whenever we plan, we need to set assumptions that are realistic. And really, we should be conservative in our assumptions. So we give our planning the best chance of being right. If we assume for a slightly worst case scenario, that's usually beneficial. Whenever I'm planning with and for a client, I always set conservative assumed rates. So perhaps lower growth rates than we might actually expect from their portfolio, or higher inflation rates, or lower earnings growth if they're still working. I think that good planning is based on decent assumptions, so it's worth doing some work on what that should be. But aside from the numbers, we're making some sort of qualitative assumptions, such as I will always be able to work and earn a rising income. But what if you can't? I've said before, your income really is everything when it comes to wealth building. Without that, you're dependent on inheritances and lottery wins and stuff like that. If you can't earn an income, what exactly are you building wealth with? But when it comes to your income, you can protect it if you're unable to work due to illness or injury. That's called income protection insurance. I've covered it in a couple of previous episodes. Again, links in the notes. But you can't insure your income source being made obsolete, either by robots or some other means or computers or whatever. So perhaps we should consider diversification to this area as well, our income. Perhaps we start a side hustle or a second job, or we develop skills in our spare time that we might be able to draw on in the future. Is it dangerous to assume that we can always do what we are doing now? I don't want to make anybody paranoid, and I really don't think probably that most of us will need to lose too much sleep over this, but it's definitely something to think about and, as ever, to be intentional about. When it comes to planning into retirement, there are a couple of extra risks to be aware of. One of the things I often see is too conservative assumptions, particularly about spending. So I've talked about being conservative with assumptions when it comes to things like growth and inflation, but too many people underestimate their spending. So whenever I'm planning for clients, I always ask them to analyze their spending and try to project it into retirement. It's really important, right? Ultimately, retirement is about having enough to spend for the rest of your life. And in order to assess that, we need to know what they're spending. We also know they're going to have a bit more time on their hands when they're not working. So whatever figure they come back with, I'll usually add quite a significant margin to it, a sort of margin of error. And particularly if I get the sense that they've guessed, right? Some clients come back with like a really robust Excel sheet analysis of the average spends in all their categories over the last 3 years, and you just know that they've tracked everything to the penny. Other clients just go, I don't know, really. It's about $3,000 a month. Do we spend? What do you think, darling? Yes, about $3,000 a month. Maybe 4. Sometimes and it's just like, okay, right, you actually don't know what you're spending. And so for those folks, I ramp up their projected expenditure quite some way. Most people underestimate how much they will spend in retirement, and hardly anybody properly considers lump sum expenses, right? Not just living, eating, holidays, or whatever. What about changing the car? What about potentially having to help out a child who's got divorced or whatever? So my job as an advisor is to make sure that my clients' plans are intelligently built. Sometimes that means speaking straight to a client when they think they're going to spend at one level, when it's clear they're going to spend way more than that. So whatever assumptions you're making, you're going to need to stress test them to see if the plan still stacks up under that stress. If it doesn't, you're going to need to plan for some contingencies. So guard your assumptions, be intelligent and conservative with them for the most part. Second thing is to guard against market risk. So as we've said, we can't control markets themselves. Anybody who says that they can spot patterns or makes predictions based, the wind is sort of blowing from the north and it's the second Tuesday in Lent, that means the markets are going to go up tomorrow. Well, anybody who says stuff like that is a charlatan. Don't believe them, right? I've long since given up trying to even guess what markets might do, even though my clients still ask me, right? What do you think markets are going to do next year, Pete? I don't know. I've got colleagues up and down the country who actually have crystal balls on their desks for exactly when the client asks them that question, so that they can just say, hang on a minute, let me just check my crystal ball. And they pull it out and they gaze into it. Sarcastic, of course, but it gets the point across. I've no more idea than you have what markets are going to do, and neither does anybody else. So guarding against market risk starts with acknowledgement that you cannot manage the market. You can't predict it. You can't time it perfectly. So you might as well not even bother trying, right? That's the first thing to acknowledge. But what can you do? Well, lots of things, actually. If you're worried about investing a lump sum, let's say you come into a lump sum, small inheritance, large inheritance, or whatever. If you're worried about investing it in case it's, quotes, the wrong time or a bad time to do so, you can drip the money into or out of, if you're taking money out, you can drip it in or out of the market over time. In so doing, you will be averaging out the impact of your buy and sell trades. But it's actually a bit of a flip of a coin that. Either you'll wish you'd invested all on day one, or you'll be glad you didn't, depending on which way the market goes. But you will feel like you're doing something to mitigate the impact of fluctuating markets. That might make you feel better, and that is reason enough to do it. I often do that with clients because it just makes their life a little bit easier. Generally speaking, the maths will say to put the money in one go, but that's a gamble as well. We don't know. Depends on how the markets do. So, you can drip feed into the market. You can diversify, obviously. It's like investing 101. Diversify your investments into different asset classes and different geographies. It's the classic eggs in multiple baskets thing. And the whole point of diversification is to buy things which behave differently, right? There's no point buying 6 different property funds, as I used to see some advisors do. It's like, no, you might have sort of 6 different fund managers, but they're all buying the same thing. So that's not negative correlation. They're going to behave similarly. You're after negative correlation to some degree. The thinking is that if one of your asset classes is suffering, then maybe another asset class somewhere is holding things up a bit. I mean, that's happened very clearly in the coronavirus crisis this year. The UK stock market has behaved very differently to the US stock market, for example. You're investing in shares in companies in both markets. But the different geographies, the different kinds of companies in each market means that they've behaved differently. And so you wanted to be in both rather than just in the UK, right? You can also diversify the providers that you use, right? So you're not too exposed to the failure of one provider. And by provider, I might mean platform provider or fund management house or whatever. I tend not to lose too much sleep over this because there's all kinds of protections in place for consumers. Financial Services Compensation Scheme, the client money rules, which means providers have to keep their customers' money from their own money. When investing, you should rebalance regularly. It's part of getting your asset allocation right. And rebalancing is resetting the mix of your investments back to what they need to be given your plans and timescales. And again, we come back to planning assumptions. It's fairly easy to get information about how assets have performed in the past. And while every single piece of investing literature carries the warning that the past is no guide to future performance, you actually can make some intelligent assumptions based on the past. You should never see investments in the abstract, though. Maybe you might need to change, actually, the balance of your investments, not in light of how they've done, but in light of your changing circumstances. That's why it's important to review things regularly. So you can limit the damage potential of market risk by staying on top of your portfolio, by being intentional. Okay, there it is, that word again. So stay on top of market risk with simple, sort of timeless portfolio construction techniques. Spread your money around, diversify, negatively correlate, rebalance where necessary, basically. Number 3, guard against inflation. So inflation, as we've said, works against you as you're building wealth because it reduces the buying power of every pound that you have year on year. To guard against that, you just have to beat inflation. That is, you have to make your money grow by a rate higher than the level of inflation, so you're getting richer in real terms every year. So that means accepting market risk as the price of entry for wealth building. If you are too afraid of what the market might do to your finances in the short term, you will never benefit from what they could do for you in the long term. I'll say that again. If you're too afraid of what the market might do to your finances in the short term, you'll never benefit from what they could do for you in the long term. Accepting the fact that your investments might go down on the way, on the way to going up eventually, that's just non-negotiable. Markets fall and your investments will fall too. If you're invested in such a way as to give yourself a chance of beating inflation. Right? If you're going to beat inflation, you're going to experience volatility. Right? That's the way it is. But you should push hard for growth. And in general, big underline, massive letters, in general, you should take more risk with your money than you think. I almost hesitate to say it because, probably I'd get in trouble with a regulator or something, but somebody's got to say it. And as long as you spread your money around intelligently, diversify, stay on top of things, keep things under review, you're not going to lose everything, right? If you invest in shares of one company, you might. If you invest everything in Bitcoin or in wine or, rare books and the warehouse burns down, you might lose everything. But the kind of investing we talk about here on Meaningful Money, the chances of you losing everything are slim to none, right? But you might experience some really big swings in the value of your funds, right? Might go up or down. Jim Collins, J.L. Collins, author of The Simple Path to Wealth, talks about investors being left bleeding by the side of the road by markets, right? Very often people's fear of the markets, I think, comes from a position of ignorance, not willful ignorance, but just a lack of understanding of how things really work. So the answer to a lack of understanding, of course, is education. That's why both you and I are here today. When retirement rolls around and you're not likely to be able to add to your wealth any further through working, it can be tempting then to sort of dial back the risk of your investments and your pension funds. I had an email exactly to that, to that end this week from a client. I had to remind him, it's not smart to dial back the risk of your investments and pensions when you hit retirement. It sounds like it makes sense that, well, I'm not going to earn anymore. This is all the money I've got, so I don't want to risk it. But if you take that tack, all you're doing is giving inflation a foothold. If you dial back the risk to minimize volatility, you're asking to underperform over the long run, right? Instead, you should plan for market risk, accept it as a given, and plan it in. Factor it in when you construct and manage a portfolio. Factor it into your withdrawal strategy too. If you're in retirement, then you're going to be drawing down off assets, so you need to plan that. You can give your assets a greater chance to grow if you're not cashing them in to cover your spending needs, at the wrong time. If markets happen to be down and you have to take 10 grand out of your portfolio, that's going to be doing more damage than if you take 10 grand out when you're in profit. So instead, you should ladder your portfolio. We've dealt with that before, to make sure that in almost every foreseeable situation, when you are drawing down off your investments, you're actually drawing down cash, or at worst, super low risk investments, perhaps like a gilt fund. You're doing that rather than from the growth engine of your portfolio, the equity part, the real bit which is going to help you beat inflation. So worth me just mentioning at this point, this is exactly the sort of thing we're going to be addressing in the third phase of Meaningful Academy that is launching to founders on the 6th of January, 2021. If you're not on the mailing list to be kept informed of that, head over to meaningfulacademy.com and click to say that you're interested in the retirement planning phase. There's a form there to leave your details. It's going to be my best work, I reckon, and I'm super excited to share it with you. So definitely check that out, meaningfulacademy.com. But one sort of point on that, remember there is a golden rule. Don't take more investment risk than you need to. You probably should take a bit more risk than you're comfortable with, but don't take more than you need to. And that's where planning comes in. With some idea of the returns that you need to achieve your aims, you can take an intelligent view on how to invest, give yourself the best chance of hitting those returns while harnessing risk sensibly. It's a big subject, though. Big subject, but nothing that anybody listening to this can't do for themselves with a bit of effort. Okay, number 4 on what we need to do is to guard yourself. All right, perhaps I should say guard ourselves and include myself in it. By far the biggest factor in your success, financial or otherwise, is your behavior. The decisions you make, the manner in which you make them really is what it's all about. So as an advisor, I am required by my regulator to try and ascertain my client's attitude to risk. I hate doing it because the questions we're supposed to use are unhelpful very often. Behavioral risk tools like the Beam app, they are far better in my book. There's a link to Beam in the notes. The reason they're better is that they give me some insight into how my clients might react in certain circumstances. And all the other risk mitigation strategies I've talked about here, none of which are rocket science, and there's tons more besides, really they are about making it easier for you to behave well than anything else. They are constraining the impact of planning errors and market fluctuations so that you're not as likely to do something daft. So I covered this in some detail with my friend Neil Bage back in season 15. There's a link to that as well. Lots of links today. But for today, I really just want to drive this point home. You are the biggest factor in all this. It is your choice to save or spend the extra money you've just come into. Your choice to invest in the higher risk portfolio than perhaps you might be comfortable with at first. Your choice to educate yourself to better understand this stuff so that you are more comfortable with a more aggressive investment mix. And as always, it's your choice how you react. We are animals, yes, but we're evolved animals. We can operate from a position of self-control rather than just being slaves to our baser instincts. Obviously, we'll never get it anywhere near 100% right, but by pursuing knowledge of abstract concepts and understanding of ourselves and of our nature, we should comfortably outperform anyone who refuses to pursue this understanding and self-control. So is this really the ultimate guide to risk or not? I don't know, really. I think it clarifies some things. But note that I've hardly talked at all about things which the financial services regulator says are very important, things like attitude to risk the capacity for loss. Those things are necessary for the regulator to protect people who might not want to know any better really about how money works. But if you're listening to me now, then you are already leveling up your ability to cope with these main risks we've talked about. Why? Because you're educating yourself. You're gaining an understanding both of the concepts we're talking about and your reactions within them. So all I'm suggesting really is that you continue the journey forever. Sorry about that. No weeks off, no relaxing your guard, no slipping into drift or abdication. We must be constantly, continually intentional. That is the way to mitigate risk to the best of our ability. Understand the risks, make good decisions in light of them, make it as easy as possible to make those good decisions. Essentially, that is risk management in a nutshell. Now, one of the ways actually to be constantly intentional is to accelerate your learning, as we've talked about, and to celebrate the season of Ultimate Guides, I'm doing an offer on Meaningful Academy, which is the best place I know to learn more about this stuff. So the last few weeks' Ultimate Guides, ending today, have lent themselves to the build wealth phase of the Academy. That's for folks looking to understand investments, how to pursue financial independence. I show you how to use the free tools on Morningstar to choose the right funds to invest in. You've got guides on there, calculators, video lessons about choosing investments, financial planning, behavioral finance, a whole section on that. Plus, you get a year's access to the best financial planning app in the world called Voyant Go, and a bunch of videos showing you how to use it, right? We talk about assumptions there. So really everything you need to get your finances off on the right footing. And there's a private Facebook group so you can ask questions in a safe place from people who are in a similar position to you. If you want to take radical action quickly, Meaningful Academy is the best place to do that. To find out more, go to the link below here, meaningfulacademy.com/special-BW, right? This episode is coming out on the 2nd of September. The special price expires this coming Friday on the 4th of December at midnight, all right? So meaningfulacademy.com/special-BW. Don't miss out. Okay, here's a review from TJC59, headlined "The Gold Standard for Personal Finance Podcasts." I've been listening to Pete's podcast for over 3 years, and this review is well overdue. It is, but thank you. Better late than never. By far the best information and perspective on personal finance I've come across. Pete gave me the confidence to retire safe in the knowledge that I can manage the finances myself. Fantastic. Each episode is focused, practical, and delivered in a friendly and positive way. Congratulations on creating such a wealth of learning. Many thanks. Well, thank you to you, TJC_59. Really appreciate it. Do you know what? I love more than anything to hear that people have taken action and that I've been able to give people confidence to do this for themselves. Anybody listening to this can manage their entire financial lives on their own if they want to, right? If you don't want to, go to meaningfulmoney.tv and click Work with Pete and get in touch, and we may be able to help you. But thank you, TJC_59. If you want to leave me a review, if you like what you hear, then please do that. meaningfulmoney.tv/love gives you a whole bunch of options as to how to leave me a review. Just helps other people to hear about the show and subscribe because it keeps me near the top of the rankings. Okay, so I'm taking a short break from season 18 until after Christmas. Next week, I've got an in-between episode for you. Brilliant interview with a gentleman called Dr. Ash Ranpura about an initiative called the Money Wellness Index, which is by First Direct Bank. Really good conversation about the relationship of money to well-being. It's an important subject. But that's it for this season for now. We'll be returning to season 18 in the new year. Looking forward to that. Looking forward to a few weeks off as well. But I'll speak to you next week. But in the meantime, thank you for listening to this one. Hope it's been useful. Questions, comments, go to the show notes, meaningfulmoney.tv/UG7. Talk to you next week.